It's not just motorists feeling the pinch. The International Energy Agency says at current prices, the world's leading economies will fork out $1.5 trillion on oil imports this year. That's an expenditure few can afford right now. Already weakened by Europe's sovereign debt crisis, high oil prices could tip the world economy into recession. According to the IEA, every global recession since the Second World War has been preceded by an oil price spike. Take a closer look at this graphic and you'll see what I'm talking about. Oil prices spiked in 1973 with OPEC's oil embargo, in 1980 after the Iranian Revolution, and then the Iran-Iraq War, again here during the first Gulf War in 1990-1991, and in 2008 when oil demand pushed up prices. After every spike, as I noted here, recession followed. For more on the rising price of oil, I'm joined by Feridun Fesharaki. He's the chairman of Fax Global Energy and, of course, a member of our GX20 panel of experts. Nice to have you back in the studio here in Abu Dhabi. It's interesting. The market now has built a floor, if you will, at $125 a barrel, which means that the record price of $147 in July 2008 is really in striking distance if something happens in the Strait of Hormuz. Do we have demand destruction already at a price of $125 for North Sea Brent, though?
I think we do. Demand destruction starts at anywhere near $120 for Brent. And this time the price increases haven't been as sharp as the rest. It's about $10, $15 up. So not quite comparable in percentage-wise to the previous hikes. This time the market is very weak. The demand prices should not be there. It is really the price of fear and misunderstanding and misreading.
Okay, I want to bring that up here during our conversation if we look at the graphics about the higher prices we're expecting from the IEA's suggestion for 2012 vis-a-vis 2011. This is the import cost for oil itself, $472 billion to $502 billion, $50 billion more in the European Union. We see similar spike increases for the United States, which is coming in at $426 billion this year for an oil import cost, and then China. And we had President Obama talking about this on his visit to South Korea. We're looking at here about another $40 billion for China to $251 billion. That rising demand growth remaining at 7% here. Has the U.S. candidly mismanaged this idea of trying to get its partners to cut its demand from Iran and then suggesting there's plenty of oil in the market by basically putting in that fear factor you were suggesting?
I think it is a very delicate balance. The intentions were try to bring pressure on Iran, but in return, we're having pressure on the oil market. And every time the signals are for the price of oil to go down, then the fear factor pushes it up. So in fact, we've negated all of the economic signals which should take the price of oil down by creating the fear factor.
Yeah, there's two different markets. There's that physical market for oil, which is in the tankers or in the refineries and being placed in orders. Then you're suggesting there's a paper market, those trading as an investment, and that's where the real price spike is really taking place here. They're taking advantage of that fear factor and driving prices higher.
Well, we have given reason to the paper traders and the speculators to create volatility. If there was really a physical market, I think what the U.S. wanted to do could be done. But the U.S. administration never figured on the pressure of the paper markets. We have about 8-to-1 trade of paper versus physical. So we are exaggerating and increasing the impact of any kind of fear by several times more than it deserves.
It's quite interesting. When Saudi Arabia decides to mark its territory and say we have oil and serve that traditional role as the swing producer, as it's done in the past time and time again, this time the market seems to be looking at the glass half full, not half empty. They don't think there's really credence in these statements or not?
I think everybody knows that the Saudis do have a lot of spare capacity, but how quickly is it available? That's the question. I think that adding 2.5 million barrels per day overnight with short notice is highly unlikely, and I don't think the Saudis claim that either. It takes time for them to increase capacity. So the market is responding to short-term ability to increase the volume, and that may be limited to 500,000 million barrels per day within a 30-day period of time.
You know the politics better than anybody. That's why we have a member of the GX20. Is the U.S. trying to accomplish here a cut of Iranian demand by 15 to 20%? They're telling the partners, look, you don't have to go full throttle here, but 15 to 20% will do the trick to send the right message, and that's not easy to manage, the politics.
Well, that's right, John. The U.S. has essentially a half-hearted policy. On the one hand, they want to keep the price of oil low. On the other hand, they want to put pressure on Iran. 15, 20%, maybe in physical terms, would be replaceable by others. but it feeds into the speculative market and the paper players. As a result of it, this impact is exaggerated. I think this is the problem, that the U.S. has to decide one way or the other. It can't do both of them at the same time.
Yeah, in fact, they're giving exemptions to 11 of their friends, in a sense. I say that kind of sarcastically here, but 11 exemptions to those who are cutting the Iranian crude but just haven't gotten to the targets yet. China and India are not two of those 11. Do you see China and India really behind the scenes telling those that are trading and putting these orders in to cut back eventually on Iranian crude or not?
One thing to keep in mind, one of the 11 is Japan, and they haven't even negotiated the contracts with Iran, which comes next month. So this is an exemption in advance of believing that they will do it. But if China and India really cut back, the oil prices will go to $150. We have to realize that we can't do both of them at the same time. China and India are huge buyers, so we have to be careful, very careful, how much pressure we put on them.
Okay. Right now, it doesn't seem to be working. That's a fair comment, right?
I think that's correct. They won't be working because there is not enough oil in the market immediately to make available. Iranian oil is available today.
Okay. Good to see you, yeah? Thanks for
Thank
stopping
you very
by
much.
this video.
Thank
Feridun Fesharaki of our GX20 and Fax Global Energy.